So last week, before Kevin, one of the things that we did was going through the whole four-quadrant model to understand how each space, each quadrant, any impact in each quadrant will have an implication for the whole market equilibrium and will affect the different parts of the real estate market. Now, that is one purpose of the four-quadrant model, but still there is a big question of what is actually the first trigger of climate change in the real estate industry. It's very different if the tenant is the tenants are the ones that are triggering the first response to climate change, or is actually the investors and the owners and the financiers that are the ones that are triggering it. Because the responses from policymakers and the owners and the real estate investors are very different, whether you want to actually compensate tenants or you want to reduce risk associated to an asset. Also, when it comes to the valuation of assets, this has very different implications because it means either you adjust the numerator of a discounted cash flow of an asset down because there is exposure to climate risk, so then you actually expect that the rents are going to go down, or you adjust the denominator because you need to adjust the risk associated with that asset or the access to financing of that asset. So the way that you impute climate into the model and the valuations is very different. So how it is actually being at the moment, how the markets are actually being impacted at the moment is something that comes down to an empirical question and to empirical papers. So one of the things that I brought here is actually seeing different papers that try to dig down into whether it is the numerator, the rental cash flows that are affected, or is actually the denominator, is actually the capex, is the risk associated with the asset what is affected. So you actually understand how climate risk is actually being incorporated into markets, if at all. So there are price discounts associated with climate risk, and you know we had in the Green Cities lecture a whole discussion about how you do this from the empirical perspective, apple-to-apple comparison, and so forth. The way that these people try to have an apple-to-apple comparison, since if you look at properties that are next to the coastline versus properties that are inline, will result in a very different comparison, right? Because if you have a sea view, if you have these condos next to the beach and so forth, you cannot easily compare the prices of those with properties that are in Midtown or in the suburbs. So the way that people are usually doing is trying to compare properties with the same level of risk, but that have a different saliencies of that risk. So either properties that are having different information at the purchasing time, so they have different description in places like Zillow or CoStar for commercial real estate into how the property is exposed to climate risk and how resilient it is, the property, because of the characteristics and so forth. So this is how they actually do this empirical work, comparing properties with the same exposure but different saliency of the risk. So then you understand that when the purchase has been done, there is the property that have a more salient information about climate risk being more prone to discount those factors in the valuation and in the purchase. And what you see is actually when you compare the properties with more saliency to climate risk versus not, that the risk, the changes in prices are there. So around minus 3% lower prices associated with being exposed to high flooding risk, sea level rise, but there is no change in rents. Which means that when you really think about the formula to calculate property prices, it seems that it's not coming from the NOI, it's not coming from the rents, but it's actually coming from the cap rate. That is also something that makes sense because a lot of the risk associated with being in a flood prone area is something that is in a multi-decade horizon, right? It's something that is not going to happen within a lease of 5-10 years, but it's usually happening in 50, 60, 70 years. That's where the risk starts to become more latent and more salient. So it makes sense from the conceptual side that if the prices are adjusting, it's not really coming from the NOI because there's no disruption in the business or disruption in the amenities of those places, but it's actually disruption into your expectations of risk associated with that down the road. You know that eventually some of those properties will face some problems, some destruction, and that will actually interfere the cash flow of the properties. Similar story happened when you look at the actual disasters. This is New York before and after Sandy, and what you see here is the development of the different properties, the prices in the different properties. The ones that didn't have any damage, this is a slight discount around like 9% reduction in prices compared to the pre-Sandy levels. That is also something that the properties with major damages end up stabilizing, and also the properties with minor damages. So it seems that there is a discount there, and it's nothing related to the actual damage or the actual destruction in the property, but it's something, again, related to the update of beliefs of how those properties are going to be hit again in the future when you are making those purchases. And this is a simple graph just to illustrate, but of course they do all of these econometric analysis that Siqi expressed in the Green Cities lecture to make sure that it is nothing there that is confounding the effects. But the story is that it seems that is an updating in beliefs is something that is an updating in beliefs that comes via the cap rates and the risk associated with those properties, and that is something that will ultimately result in reduction in prices. It is nothing that is coming down at this specific moment through the leasing and through the rents and so forth. So here, the key thing, and that's what we're going to start talking with me, but also mainly with Siqi, is how do we actually understand better the role of those beliefs and the formation of those beliefs, because that is the critical channels via which climate risk is actually being translated now into specific actions as of today in the real estate market, okay? And that is why it's important not only understanding how everything unfolds in this 4-quadrant model, but also understand what type of quadrant is being affected, because it's very different when it comes to understanding how to tackle climate risk, whether it is the numerator, is the rents, or it's actually the denominator, and it's the cap rates and the discounts associated with that. Now, this is the discount rates are especially important when you also start thinking not only about the value of those assets, but also investment in those assets. Because when you are thinking about investing in climate resiliency measures, what you are doing is, again, similar to the energy efficiency story, you are investing upfront to avoid future risk and avoid future penalties or future stranded asset problems. So now the difference with a lot of the difference with climate risk is that it's even more important, the discounting, that with a lot of the energy efficiency and transition risk issues, because with transition risk, with energy efficiency, we are looking at things like Local Law 97 that is happening next year and is going to have even more penalties over the next decade or two. But climate risk, we are talking about probabilities of bad stuff to happen in the next 50 years, in the next 100 years. So any minor change in the discount rate is going to have major differences into how the expected damages that are going to happen in the future are going to impact the valuation today. Because you are compounding things that are happening 10, 20, 30, 40, 50, 100 years from now. So any minor tweak there is going to bring these guys down a lot or up a lot. So there's a lot of discussion about what will be the right discount rate, and I'm going to actually show you a very clear example around the corner. There is a report about how to think about resiliency investments at the district level in Boston Seaport by the city of Boston. So if you see the numbers, you see that for the different predictions of sea level rise by the different decades, so you see that now at the moment there is no sea level rise, this is the baseline. Then you see like it's expected to be 9 inches by 2030, 21 inches by 2050, 40 inches higher by 2070. Those are the predictions of the city of Boston. And these are the damages that you have. So different number of people that are affected, different number of buildings that are affected, and what is the value of those buildings and and what are the cost in terms of property damages and lives being disrupted. It goes up also as the sea level goes up. So if there is no resiliency interventions, this is what the damage will be. We'll start around 140 million as of now, all the way to 8 billion in the future. So now what we are going to do is actually thinking about all of these framework to assess whether it is worth investing in preventing those damages or not, given the predictions of the city of Boston. Andy.
We saw a similar table yesterday in studio from a city official who came in and asked a similar question. He wasn't able to give me a direct answer. So the same study from 10 years ago predicted 9 inches of sea level rise by 2030, which is only 7 years from now. So we're past the halfway point. Have we seen 4.5 inches of sea level rise? Is there actually 1.2 billion in damages that have been experienced, or 50% of that 600 million in damage that have been experienced to date? Or is this being updated with new projections to reflect what's happened over the last 10 years?
Every report that you have there of this kind will be always using the latest prediction. And you saw the table of the beliefs of the IPCC, the United Nations, regarding climate change. That is updated every 4 or 5 years. So especially in 2022, there was a big update around those projections of the damages. Here, what you will see is these are usually what you get in to get these numbers is actually the properties that are going to be exposed. So the properties that are here in this blue area times the value of those properties, and that's how they calculate the 8 billion.
Right, but the study itself that was done, this one's dated 2013, the one we saw yesterday, 2017, both showed 9 inches of relative sea rise by 2030, which is 7 years from now. Have we experienced more than 50% of that increase to date? I'm just wondering, like, what the prediction was 10 years ago. Has it actually come into fruition, or is there a need for more conservative estimates as to what the damages actually will be by that year?
Yeah, there are two things there. I don't know exactly the numbers of how much of these 9 inches have been already observed. There is some sea level rise that has been, of course, observed there. There is a risk of doing that type of logic. That is that you assume some sort of linear increase in sea level rise. Every year I get more and more and more and more, and the same delta will apply every year. But actually a lot of these things are not linear, because if you try to visualize how things in Greenland, for example, work when it comes to melting of ice, these are big chunks of ice that eventually will come into the seawater. And those doesn't happen like kind of the same chunk of ice happens. Actually, the worst that can happen in terms of sea level rise, that there is these big parts of ice of places like Greenland that become out of the sudden detached from the big block of ice. So it can be that it is like, say here, you have like 2 or 3 inches happening for the period of 5, 6 years, and all of a sudden there is such an event that they call tipping points, and then you go up to 7 inches. So I think that it is hard to back up a lot of these issues with empirical observations on a year-to-year basis, because a lot of these observations happen by very thorough assessments of de-icing and different events that that will end up happening and that will end up having a consequence on the sea level rise. Yes. Yeah.
Just like for background, Andy, like it has actually risen like 8 inches over the past 10 years, and there's like some data like I find online that shows like the actual numbers like year by year. So yeah, I think it's based on historical data and projected data.
Awesome. And here is the plan of the city to invest in a lot of protection mechanisms to avoid that you see low battery. Everyone has low battery, including myself. So here it is let me see where I can get rid of it. No worries. It's low battery, but not that low. These are the costs associated with protecting seaport. You have a front point channel, you have a different waterfront, different city walls that you will put all over the area to make sure that there is no such a thing as those damages that we were projected in the previous one, to avoid that the properties and the people are exposed to that one. And you see that it's quite a lot of money here. You have a total of around from $500 million to $1 billion, and going to 7 million to 15 million in maintenance, because once you build that infrastructure, of course, you cannot stay there forever. You need to maintain it every year. So it's a significant investment that you have. Is 1 billion. Let's be pessimistic and conservative. You will have to invest 1 billion to protect the city against 8 billion expected damages. So what you see is that, and damages that will happen all the way to 2070. So again, what discount rate you will put will make this investment worth it or not, because you need to start investing those things now. And these damages will only happen severely over the next decades. So, yeah.
the damages also in present value?
No, they are when they will happen. So here is what comes down to. So if you think about investing 1 billion to protect the city for 8 billion of damages in 50 years, you see that any changes in the cash flow will actually make a big difference into the decision making. You know, we have always this in this course, NPV positive, NPV negative, and anything that you have here from 7 to 1%, that is sort of like a lot of the discount rates that you end up seeing in the literature, you see that there will be a very different outcome. So anything that will be below 4 will actually make it that those damages will be counting enough at present and will actually make it big enough to make sure that this number is above 1 million and therefore make an NPV positive solution. And that's where a lot of the discussion and a lot of the decisions need to be made when it comes to mitigation, resiliency, and so forth. This is not mitigation in terms of reducing CO2 emissions, because that will be even an extra loop of complexity, but already just thinking about resiliency versus expected losses and getting hit, you see that the political decision is how much do we value those, or how much do we believe in those things to happen, and then ultimately, even if we have an assessment of the damages and we all agree in the room that those damages are there, then the next question is how do we discount those to the present to make sure that we have a fair evaluation. If you see the actual data, you have these papers now evaluating like these very long discount rates. It's a very complex exercise. Actually, they do it with housing markets because you can actually use the differences in lease terms to actually see how people will value those cash flows in the very, very far future. So for example, I think Singapore has leases of 90, 100 years. You can compare those with perpetuity type of things to see how people will value the 100-year losses versus perpetual losses. And you see that the discount rate that is usually there is 2.6 in the literature. Yeah,
so
Derek.
This discount rate is trying to capture how the end users of the property would value this, because it's the government itself that's spending this money.
Correct.
And the government doesn't really require positive NPV investment.
Exactly.
Right? So.
Exactly. But you want to kind of like the ultimate homeowners, what will they value, right? Because even though you as a government, one of your missions is to do NPV negative investments there, because otherwise it wouldn't happen. You want to have some alignment of what these people will value and so forth to avoid burning your political power. Julio.
I'm sorry, I'm just trying to get this right. So the 8 billion is the damages of the properties that are there right now.
Yes.
But you could have more properties or taller buildings, so the 8 billion could actually be a lot more.
Yeah. In Seaport, I think not anymore. I think that everything is fairly developed already. This for Seaport. Yeah.
But in 50
I
years,
think in their studio class, they
They're
have
still?
vacant land too.
Okay, so there might be so that might be that even there might be some more damages because you develop more property and you put more capital there. Yeah. Yeah. So that will make it even worse because that will not be 8, but it will be 10 if you keep developing high rises in areas that will be eventually hit by.
it would make it more feasible.
Yeah, exactly. Yeah. Yeah, because then the 8 will become 10, so then everything will be, and this is sort of like a public good for the entire district. It doesn't matter whether there are here 5, 10, 20, 300 buildings. You are trying to protect the whole border and protect everyone inside. So actually the emptier it is, the more difficult it's going to be to justify the investment because the less damages are going to be there. And now we're going to keep going with all of these discounts and so forth with Siqi and how we are actually going to think about those beliefs in a more thorough way.
Yeah.
Exactly
So,
10 minutes.
Well, yes, good. As we switch, actually, just now, the last question, I think you touched on a very interesting thing about this, the protection that the government is investing in, like seawall and all the things. And if the government invests a lot, then that will boost the confidence of the private sector, right? The private sector will say, oh, this is not a big problem. You can just invest, you can further develop. So that now is a debate, it's an endogenous thing. If the government invests a lot of money to protect that area, then the developers, the individual investors, they feel more confident to further invest in that area, to build buildings and like that. So that may lead to a misallocation of resources. because the city mayors, they always want to protect their cities. And then those dangerous places, risky places, they got more and more private investors to build it there. So, okay, anyway, now let me continue. So basically, I think we are the first real estate program. I'm very proud of this, that we have this sustainable real estate as a core class. Maybe you like it, maybe you don't like it. But we are the first real estate master's program that we have this sustainable real estate as a core. And also, I think we are the first that we have 3 sessions dedicated to climate, because we know climate is so important. And last year we had 2, and we couldn't finish. So this year we have 3. So we are now in a hurry. We're now in a hurry. We are going to enjoy the process of these 3 lectures and all about climate. So after the 3 sessions, you become expert on climate and real estate. So that's the point. So today I will continue, and then next week we will have another last session, and I'm going to invite a guest speaker. I don't want to stand here always talking, too boring. Last session we have Moody's Kevin. Then next Tuesday, we will have a very important person who is a former head of the FHA, Federal Housing Authority. So that's a big federal housing administration, and also the senior leadership in the Fannie Mae and Freddie Mac for many, many years at Golding. And he will come here. He is now a senior lecturer at the Sloan School, heading some housing research center there. And he will give a guest talk next Tuesday on climate and real estate, and how from this government perspective, this HUD and FHA and Fannie Mae, how they are thinking of this and whether they want to invest more money, public money, to help those places that got flooded. So that will be next Tuesday. But today will be Juan and me. Now it's my turn. So this is the second lecture on climate and real estate. So just now, I think I can continue just now the conversation, because just now we talk about discount climate risk. And then we know that climate risk is a future risk. So it's not today. It's not today. It's about future, next 50 years, next 100 years. So Juan, where's the pointer?
Oh, it's right here.
Oh, okay. Oh, here. Okay. Because the real estate is a long-term thing. It's not like one day, a long-term thing, holding period many, many years. So we all understand the analysis is about future. When we talk about climate risk, always about future things, that is this discount rate. Just now, Juan mentioned that it's so important if you choose 2.6%, or you choose 3%, or you choose 5%, totally different. It will yield different NPVs, right? So that's the point of this discount rate, so important. So that's this IPCC as RCP, right? Representative concentration pathway, and RCP 8.5 is very serious global warming, and this one is like if the human beings can mitigate. So then think about this. Hypothetically, you buy an asset 2020. Then maybe you will just hold the asset for many, many years, you sell. So now, when you are evaluating the impact of climate risk, you are thinking like in this way. You are thinking like, because the global warming become more and more serious, right? Now maybe no problem. Just now Juan showed the seaport. For now, no problem. But then little by little, more and more hurricanes and the sea level rise and all kinds of things happen. So conceptually, we say, okay, when me as a buyer, 2020, I stand here at this moment to consider whether to buy or not, and my bidding price. So I'm standing here. So my current bid for asset is the present value of the future cash flows, and for example, all other things, and minus the present value of the expected climate damages. Who knows, right? All the scientists, they publish so many papers, but they are all guessing. They're making all kinds of projections. So This expected. That's so important. And then you say, okay, from the scientific report, we also wrote many, many papers, and we published, and so many climate scientists, they say, oh, cost of damage is this. Every year, the likelihood of the hurricane. Then the thing is, you can do two factors here. Discount rate, just now we mentioned, this is so important. 2%, 3%, totally different. So Juan covered this. Now we are looking at this. Scientists are saying so, but not all people will believe in so, right? You know it's a climate belief. So when you buy the asset, and when you think about future, you are thinking whether later you can sell that to the second buyer, the later one who will buy this from you, right? So all this market, who knows? Even if the scientists publish all these reports, and maybe half of the people, the buyers, they believe in that. The other half, they don't believe. And this one will definitely influence the buyers, future buyers, the market participants. So which means we cannot just look at these numbers. We must look at the belief. So fortunately, we also have some scientific measures of belief. So there's a very famous thing. You can Google this. And Yale University, they have a Yale climate opinion map. They have a research group. They already run it for many, many years. I think each year, they have a lot of research funding, I think. They just did a huge, large-scale survey, thousands of hundreds of US citizens. I think now they're only looking at the United States. Okay, so that's basically this. And then you go to the county level. Now this is like a county level thing. You see the county and the metropolitan area states like aggregate. Then they go there, they interview, and they have a bunch of questions. And then you have this map. They provide indexes. And then we can always use these indexes for our own research. So then you say, okay, this is 100%. So the question, they have many, many questions. This is one of the questions. Adults who think global warming is happening. Then for the thing is, for the entire United States, 72% of the adults, of us, we are adults, we think global warming is happening. And 14%, they don't think global warming is happening. And in the middle, they don't know. They are not very sure. So that's the entire United States. Of course, you understand why here we are darker. Here we maybe have a higher share. And here they're darker, and in the middle maybe lighter. So that's the situation. So, which means if you hold a scientific report like Siqi's paper, and if you go here, you get a lot of supporters. Yeah, that's true. If you go here, oh, don't just want to fake me. It's not true. I don't believe in that. Question?
I think it would be interesting to put this map in comparison to voting patterns, right?
Yes.
I'm sure they're correlated.
Yes.
And it goes back to what you're talking about with beliefs, and it just becomes so politicized. Even the word global warming versus climate change and how people use the wording, and thinking about, okay, then how are we going to use discount rates, right? Because people who don't believe in it or don't think it's as severe are going to say, hey, we want a higher discount rate, and then it makes it really difficult to try and act upon it.
Very good. This can be a research topic, like a thesis topic if anyone can. Actually, 2 years ago, we had a TPP student, the other program. He did a thesis exactly on this kind of topic. He tracked these political votes and correlate with this climate belief and other political opinions. So that's okay. So that's a point. And then, see, this is that Yale University's one. This is another thing I got from like another research institute. And this is by country. This is by country. So Greece, number one. 90% think global warming is a major challenge. And followed by South Korea, France, Spain, I don't know. Yes, so why South Korea? Okay, are you from South Korea? Okay. Do you have any sense when South Korea people, they believe in climate risk so much? That's good, huh? You all should be proud of this.
That's because in the media, they kind of advertise so people in current doesn't actually try to criticize about video states. So I think people are trying to believe those.
Yeah. Good. And I think for those small islands, because they really have the threat, right? Then they have a more sensitivity to climate, and also related to this education and public media and all this, and also politicians' agenda. So I think US is here. It was very low, and I don't know. Maybe they couldn't get into China to interview people, so no China here. So that's the point. And then let's see. Okay, so as you know, so let me do an interesting thing. Now for the entire United States, adults, 72%. Let's do a small poll here. In this classroom, this is not a representative sample, right? It's two buyers sample towards some like very dark place. Who think global warming is happening? Please raise your hands. Okay, you don't think so? Okay, so, okay, fine. We are not counting, no pressure. Okay. Yes, so I just want to show this. If we say United States, 72%, right? This is 11,350, that's our classroom. So two's here. So it's much higher than the national average. So I think that's the situation. You know it's heterogeneous, it's not the same. You have a comment?
I wanted to comment, I just seeing that Israel is last. I think the reason for that might be that I can kind of attest for Israel, that it's not that people don't believe in it, it's just that it doesn't take the place in the media. I mean, it's
too many other things.
Yeah.
Yes, that's true. That's exactly the same as in China. I think many from China that you know that there's so many other bigger challenges over there. The climate is so remote to common people's daily life, right? So that's a very good explanation. And when you are so happy with all other things, you start to worry about climate, worry about your next generations.
I think it's a good point. And also, I'd be interested in knowing the correlation of that list of countries and beliefs versus impacts. Like if you're living somewhere like right on the coast, if you live in Venice and you're actually feeling it versus a landlocked country that maybe you're not experiencing the impacts as much. I know coming from California and experiencing those wildfires, it makes you believe
that your house got burned.
Yeah,
yes.
Seeing it happen. So I'd be interested to see the correlation between that.
Good. Yes, that's very good. Another research topic. And then see, that's exactly address this graph address your point just now. So climate change is a public priority, but now it's more and more partisan than ever. So they have this table. They have this trends, right? So but these two still, I think they still United States. And see, 4 priorities. Economic growth, of course, always the first priority. Jobs, people want employment. Environmental protection, I mean, all the environment things, and the global warming. So this is a percentage of Americans who say the issue should be a top priority for the president and the Congress. So then clearly you can see a very interesting thing is they have cycles, not like they flat all the time, right? Always when the economy is good, then people are happy with jobs and the wage and all other things. They have more brain space to worry about climate. When the economy is so bad in a recession, we don't know whether tomorrow we will have lunch or not. And we're not going to worry about climate. We need to first secure a job and all the other things. So you will say, this is a financial crisis, 2009. After 2009, the priority people always thought is economic growth and the jobs and all other things. It's not about global warming. And when the economy is become better, then this go up. So, right? And then these Democrats and the Republicans, you see the gap? It's a huge gap. Partisan gap is so big. So that's basically, and then here is after COVID-19, this is recent 2022, I got this yesterday. So now it's a strengthening economy, number 1, because now we are also like in a very, very, very important moment for the economic growth. The inflation is so high. So reducing healthcare costs or something like that. And let me see, where is global warming? Yeah, here. It's very small, but global warming is here. So you can see it's not like always a priority, and it's changed over time. So that's dynamic. Okay, what's the implication of that? What's the implication? I'm going to use this paper to illustrate. Of course, we care about public opinions, especially for those who want to go to the public sector, later become a policymaker. Sure, look at this and study. But later, if you go to private sector, you are just one developer or one small investor, then you need to understand the big picture to seek good opportunities under this. So here, of course, you know climate change always on people's mind, sometimes very important, sometimes less important, and in some areas more important. Then how that will affect real estate prices, that's real, right? You need to understand if you go into a market, you go to the EU map of the climate belief, check in your sub-market what the belief index is. And you think about this will affect your business. That's so real, will affect your business, will affect real estate price, later I will show, will affect the housing developers' profit if you are going to build something on the coast. So this paper is the following. This is a very good journal. And of course, they say flood risk is so big, and especially for Florida and Hawaii, like later will be inundated. 10% will be inundated. And then they started, okay, this is like scientific fact. This is scientific report. Then this paper went into the market, really got a lot of real transactions from 1997 to 2017, and also detailed housing characteristics, whether you are in flood zone or not. If you are in flood zone, higher risk, right? And then that's in Florida. So underwater means it's a dummy variable that the home is in the flood zone. Then they got into this EU climate opinion map 2016 data. They run a hedonic model. We are all hedonic experts now, right? After my apple to apple comparison lecture last time, now we are all apple to apple experts. So we run hedonic. We regress log P, that's a housing price, on so many other things, and all these characteristics. Then we have underwater. Underwater means in flood zone, right? Then this paper found out the very interesting result. Always beta is negative. If you are flood zone, you have a discount. That's always. However, the size of the beta varies a lot. The size of the beta, the discount of the beta, varies a lot. For those homes, for those believers, they call it believers, the median, so they have the EU map of the belief, then the median value of the belief. Above belief, they call this community as believers. Under the mean value, median value, they call it deniers. So compare these two. The believers community associated with 7% larger decrease in housing price. So that's the finding. It's very intuitive, right? So which means E for those two, remember how, apple to apple. If there are two communities, these are the ocean. These two communities, both on the coast, the same climate objective risk, flooding risk is the same. These are all believers. They say, oh, this is real. These are deniers. The same physical risk. However, it says this one, housing price decreased a lot. This one decreased a little. So that's what they found. Then if you are a businessman, you are a local businessman. You are gonna build something in Seaport, for example, or some like Florida coastal area. And then you only have a few choices. You have constraints, you have these few choices, are very similar physical risk. And which community are you going to go to build your houses?
The people who don't agree.
Okay, you'd go to the deniers. Okay. And do you think for yourself as a businessman, yes, that's a rational choice, right? You get profit. But if we aggregate it's a thousand of like businessmen like you all go there to build, is there any problem for the society? Not sure. Okay. So if you are an individual businessman, of course, go here to build. Because you have higher price, you make profit, and then you have a lot of buyers. But if you have so many builders, and all go here and build, then will be more and more housing in riskier areas. When once there's a hurricane, a big damage, the damage will be borne by whom? The damage will be because you build and you sell and you leave, you go to another place to build. Who will bear the damage? If a lot of buildings just build here because they are deniers. Any sense? Who will bear the cost? Will cry. Who will cry?
The residents. The people who live there.
The resident will cry. And who else will cry?
Insurance companies.
Yes. And who else?
The deniers.
Okay, they now understand, they learned. And also banks, right? The banks, because they buy these houses using mortgage, and then all the people then get inundated, then they default. The household will default. Okay, you take over my house, default, remember? Then banks will cry, and this low-income household, they couldn't live, they have to live there, and they will cry. So that's a social problem. So I just want to keep this open, and later you can discuss it a lot. So basically you can see all these interesting topics. And then, of course, now we understand, not so many people, they know that Yale University map. Before I just mentioned who of you know, except our teaching team, we all know. Who knew this climate belief map exists? No? You heard of that?
I kind of knew that that's where people would believe in it. Based on politics, like what Bill said, Democrats more likely to believe that climate change exists.
Yes. Okay. So that means at least we cannot force people to believe something or not believe something, right? They have their freedom of belief in climate change or not. That's their freedom. But I think as a public sector or the government, they should provide information. They should provide information for people to judge by themselves. Instead, they don't understand, they even don't know their houses are in flood zone. That's not good. So this disclosure is important. This is very similar, but it's the opposite example of the green building certificate. Remember? When I talk about green buildings, I talk about market failure. One market failure is information asymmetry. So people don't know whether it's a green building or not, like that. And then LEED, Energy Star, and all those certificates, of course, they have their own problems, limitations, but at least they made a big contribution to solve the information asymmetry problem. That is a green building. This is a negative thing. Climate risk also need information. Provide information. So that's why now they have this home seller disclosure requirement mandate to the sellers, no matter it's individual sellers or developers, provide buyers with detailed information of the known material defects. It's not just about climate, but climate is a new item they require to put into that disclosure. At first, they just disclose all other things. Sewage and this and basement and materials, building materials like that. Now, they say, now it's time to add climate risk into that disclosure file. When you buy a house, you need to, when the buyer buys the house, you need to tell them. And then this mandate was implemented step by step, not immediately. It's very hard to get things immediately. Then some states started do this, and some states lag behind. You can see this also correlation with that partition or belief map, right? This like here quickly, and this slowly, but they are doing so. And my lab's postdoc, Zheng, some of you know Zheng. Zheng is the postdoc in my lab. He has a very good paper to study this disclosure. It's just a disclosure, impact on housing market outcomes. And then he said, okay, from the home seller disclosure requirement, this is better information helps. Then he showed that in those states and counties with the disclosure implemented, then you see these places losing people and higher housing vacancy. So when people, this place is risky, they start to leave, and then the market starts to decline. So that's the information channel. You just give information and let people just by themselves. Okay, that's Zheng research. And my lab has another research. We have a website, search Google. We have a global sentiment project. So this project is the following, also linked to climate change. So we use natural language processing, that's a kind of machine learning based way to extract information from social media. We started from Weibo, China's Twitter, then we expanded to all Twitter. So all over the world, now we have more than 100 countries. And this is machine learning, so we can process all kinds of languages. We don't rely on dictionary. So then we use this NLP approach to extract information about people's sentiment. Twitter tweets, when you whether you are happy or not. We have a sentiment score for each tweet, and then we aggregate. And then we link this sentiment to these extreme temperatures to show that when it's very hot or it's very cold, people are less happy. It seems very intuitive, right? But it's really heterogeneous. You can see different countries because they have different adaptation strategies. It's not all the countries are rich as in the United States. You have air conditioning, you have heating. No, some countries very hard to adapt to extreme temperatures. And then we have different countries, then we quantify, we call it emotional toll. The climate change is emotional toll on people. And basically that's you see the inverse U. So this is our paper. We will soon publish it. So that's and then of course you can link that to all kinds of other outcomes. Actually, we already linked to Juan and me and Yichun's paper. We linked to COVID, the same sentiment, and also air pollution and other negative shocks. So this is our website. Go there and take a look of our projects and the team if you want to use this index. Okay, the third project from my lab related. And it's also the information belief matters. So this is an ongoing project by my PhD student, Yichun. And so basically, this is very interesting. We further explore Twitter, not just the happy or not, but also their friendship. You know, on Twitter, you have followers and followers, and you follow others, others follow you, right? We know that information. So we create the friendship network. So which means your friends, not just here, of course here, all of us, we are friends, right? We are good friends. But you also have friends in Harvard and another state and another country like that. You have your social network. Then we see this, like Hurricane Ida, just hit Louisiana. And the Louisiana people suddenly got so unhappy because they lost homes and like this, so unhappy. And then they chatted on Twitter, and this information, not just Louisiana, that small space got hit, and also spread out. So Louisiana first, and then Mississippi, and Rhode Island, and California, like that. So this is the response, which means the hurricane hit one place, and then because of social network, that's a social learning. And then the friends have here. They learned, oh, this is dangerous. At first, they didn't know what hurricane mean because they never experienced. Then suddenly, the pictures on Twitter shows, oh, my friend in Louisiana got hit, and so bad, so miserable. Then they understand the risk. Then they adjust their belief and all the things. So that's basically our matrix of the information, hurricane information networks, and which states we have more fun with the other states, and how this information flow. So that's another ongoing thing. So these are all about beliefs. So you see, it's very interesting. It's a very soft thing. It's not like a very concrete, but we can measure, and we understand that really matters. And this soft thing will lead to tangible things of the new development. Okay, now we're gonna move on. Okay, belief is important. Now let's see how to quantify. How to quantify the impact of the climate risks on housing outcomes. So this paper is one of the first papers. I think that's on your reading list, and this is a very good paper. It's a very good journal, very good paper, one of the first several papers, and very easy to understand paper. Hurricane Sandy and New York City housing market. So I will use this, but I will expand. I will tell a big story and methodology in this paper, and after you understand this paper, you become expert. And then you can easily do yourself. I know you are now looking at the seaport in your studio project. And that one is very, very high risk of the sea level rise, right? So you can use our data and this methodology to quantify the climate risk on your seaport project. I think that's something later we will need to do as our PSAT number 2 and some analysis in Carol's class. Okay, now I'm gonna enter the boring part, abstract part. So, hedonic model on climate risks. The thing is, clearly, for example, Hurricane Sandy. So, for example, there's a hurricane. The hurricane hit an area, a state or city. Then, of course, there's a flood zone and an outside flood zone. Now, for now, we assume the flood zone is very accurately measured. Actually, it is not, but now for now, we assume this flood zone just gets flooded. And the other zones, they are not flooded. So because the flood zone may be very low elevation like that, and very close to the coastline, then we say, okay, we want to quantify this flood risk impact on housing prices. Then we have a very simple way to do so. We compare. We compare this treated, we call it treated, this one, got flooded with this without flooding. Then we calculate the gap of the housing price between these two areas. And we draw a conclusion. Is there any problem on this? Rahid?
They are not similar. It's not apples to apples.
Good. Okay, good. Now we understand this is not apple to apple. So today I don't have real apples and oranges. I didn't have time to go to Trader Joe yesterday, but next time I will bring more. So, but now let's see. Just now, Rahid already said, we cannot just compare, oh, this got hit, this, then calculate the price gap. That's too naive. Then it's all apple to orange comparison. But could you elaborate a little bit more? What kind of things potentially are different between these two zones? We are talking about the apple is not orange. That doesn't equal to an orange. What are potential differences?
The age of properties, like on one zone it might be like older compared to another.
Why the control zone will be older? What's the rationale?
Maybe it's a well-established zone that have been developed for a long time.
Okay.
And the treated zone is the like newly like landfill.
Okay, yeah. Okay, you are thinking about the seaport, like the control is the Boston downtown, and then they expand and then become the coastal area. Okay, that's possible. And others? What do you think is a systematic difference? We must look at the systematic, not random difference.
The ones in the, excuse me, some of the ones that could be in the flood zone or affected by hurricane could have a premium on them because of preferred views or better location versus some control zone may be more inland, commuter locations versus premier locations, something along those lines.
Okay, you are talking about, actually these treaty ones maybe have very good view, right? Because ocean, everyone likes ocean view, right? So if you like ocean view, you live on a beach. On the beach, you need to bear the risk of being flooded. So that's one difference. Any other things?
There could also be the flip side of that, like maybe inside the flood zone, it was a poorer neighborhood, and maybe there wasn't as much investment and redlining and different things like that, so it wasn't as protected as outside of the flood zone.
Good. Yes, maybe because inside the flood zone already like declining, right? Declining neighborhood, and people understood that, and people left because we just showed paper. People left, Xinhong's paper. People left, and no enough property tax revenue, then very badly maintained. So they already bad. So these all the different things. And another thing is flood insurance, right? Because it's required, although it's not very well enforced, but it's required. If you borrow mortgage from the bank, if you are in the flood zone, you need to buy flood insurance. So they are insured, right? And these are not insured. So that will be like, oh, I'm insured, so no problem. Even if I get hit, insured. So that is a difference. Okay, think about this. Last time I used this to help you better understand, very numerical way, understand this. Let's look at this. Let's think about the problem of that apple to orange comparison, right? So for example, there's a house, 1 million, then we decompose, that's hedonic, decompose. 3 rooms, 2 busways, 2 subway stops, and a nice park, and some trash can. There's trash can here. And now we have the inside flood zone. Now, we know inside flood zone, bad. Then, after a lot of data, crunching the data and the regression things, negative 0.1 million discount. So that's the hedonic model. Thus, we kind of compare, no matter apple or orange, you put together to compare. Then this basically what we wrong. I think that will our P set number 2. Keep in mind, this is kind of thing we are interested in alpha 3. Right? This is a trash can. That's why we have R square, which is not 100%, 83%. So that's the idea. I think you have the intuition of this. Okay, now clearly we understand the trash can is not that clean. It's not random. There are some things in the trash can which may be correlated with this flood zone location. So now I have one example, to make it simple, one example, which is ocean view. As we said, with ocean, seaport, it's very easy that you are in the flood zone. Okay, now the trash can is not that clean. Okay, so if we can observe and measure, for example, we are so sophisticated, we can measure exactly the ocean view's value. That's a very hypothetical. That's a hypothetical scenario. But anyway, if we can observe, suppose it's 0.05 million, and then this will be the remaining trash can. That's something we really cannot measure, and like that. Then we are very confident, right? But if we cannot observe the ocean view, and if in the extreme case, that the ocean view means flood zone, these two are the same thing, then you have a trouble. So basically, you will see, you just, I think this is, let me see, ocean view. Yes, so basically you will see here, so ocean view will go into here, right? Because ocean view and the flood zone is the same thing. So you naively run the regression. You don't know these two are different. You think that's the same. Then you get this. Then you underestimate the discount. You say, okay, in the flood zone, not that big deal. In the flood zone, you only have a discount of 0.05 million, right? Because in the flood zone, you also have benefit of the ocean view, right? Actually, if you can really split the ocean view out, actually in the flood zone is so bad, that's negative 0.1 million. Then this one offset this bad thing. This is negative amenity. This is a positive. If you can really measure, you get this right. If you cannot, you get it wrong. You underestimate. So that's the big challenge of this kind of research to, we call it identification, because this identification challenge is this all kinds of things in the trash can get correlated with the thing you are mostly interested in. Don't worry, we have a way to handle this, apple to apple, to make this to apple. So this is called difference in difference, DID. So maybe you heard of this technology. Anyone, I think, Wilson, you just, last time you mentioned you know DID, right?
Yeah.
Can you use a very simple language to explain to us what is DID about? Okay, you forgot. Okay, no problem. Take your time.
It's more like instead of you directly try to find the relationship between two different stuff, you try to find an intermediate as a vehicle in the middle, and you.
Oh, that's the instrumental variable.
Oh, okay.
Okay. So anyway, now we are talking about the different methodologies. Remember last time in my first apple-to-apple comparison, I taught a methodology called what? I hope you can remember the terminology.
Sorry, I actually don't, but I can list off all those, all of them. So
Matching.
matching. Okay.
Yes. The simple way is matching, right? Remember, last time we talked about matching. So all kinds of ways for us to have apple to apple. Last time we talked green building, that's matching. Green, non-green. Okay? You're very close by. Then we match green with non-green. The same location, similar things, all similar. We calculate the difference. This is called matching. Now, this is the first methodology I hope you can grasp. Now, today, the second one is DID. DID, I'm going to use a very intuitive way, apple and orange, to show so that you can understand. Now, just now we already said there are two different animals. One is apple, the other is orange. We cannot directly compare, that will lead to bias. We showed bias. Okay, now we have a way. Fortunately, this is an over time thing, right? It's not like we only observe one time point. We observe over time. So we observe like Sandy, this is a hurricane, before Sandy and after Sandy, right? So we take advantage of that. If you can only observe one time point, that's all, then you cannot do. If you observe over time, you have this way to do. Before Sandy is a smaller apple. I use this so that you understand. So always the housing price go up, right? In normal time go up. So before Sandy, the apple is smaller, then it grow larger. Naturally grow larger. And can we just compare? No question. Can we just compare this small apple and this big apple? Say, okay, I understand I cannot compare apple and orange, but now I'm going to change. I compare before Sandy, what's the price? After Sandy, what's the price? Subtract. Then this is the impact of Sandy. Any problem with this? Or it's good? Go ahead.
I mean, something else might have changed in the neighborhood.
For example?
I don't know, like a new retail in the area.
Okay.
Drove the home prices up.
Okay, good.
I mean, it doesn't also factor market appreciation, right? I mean, that also doesn't factor in here.
Okay, like subway stops, like something like that. Okay, now it's naive. This direction, naive. This direction, naive. Okay, now we have the thing. This control before. Small orange to big orange. Also grow, right, over time. Now this is called difference in the way. First, these steps. First, measure the baseline difference. Baseline means before the treatment, that's a baseline. Measure the baseline difference between pre-apple and pre-orange. So we call it pre-treatment. Actually, it's called pre-treatment, but I use this language called pre-apple and pre-orange. So that's small ones. So let's measure this baseline difference. They are different, right? So we get this. Second, okay, this is pre. This is they're different animals. Orange and apple, totally different. Nutrition and all things different, right? Then subtract the baseline difference from the end line after treatment. Difference between this post-apple and post-orange to get the real treatment effect. So that's the point. First, measure before anything has happened. What's the fundamental difference of the baseline? The two small orange and apple gap. Then, okay, we know they are different. We control for that. Now, after treatment, they become more different. And then we subtract. So that's the hurricane effect. And another thing is to like this. This is another way. It's the same. First, measure the baseline time trend from pre-orange to post-orange. Okay, this thing, hurricane never happened in this neighborhood. No hurricane thing, never happened. General trend, grow from small to big. Measure this. Then subtract this natural growth from the treatment growth. Then you will find that this and this are the same, right? Right? You just rearrange. Oh, you just rearrange. Okay, so each way is fine. Either way is fine, but you understand that you have 4 cells, and then you first get some difference, then subtract. That's why I call difference in differences. This is a two differences difference. So that's DID. It's very intuitive. Any questions here? I need to pause a little bit. Or you fully comprehend. It's not that easy.
On the left side, how similar does the left side need to be? I mean, there's already a difference in baselines, but like, how similar do they need to be?
Yes, that's a very good point. So basically the thing is, this fundamental, I think you are asking a fundamental assumption of this methodology. To make sure this methodology holds, we have a fundamental assumption is, except for the treatment we are interested in, which is sandy, other natural things, growth, are similar between this and that, right? The only different thing is Hurricane Sandy. Besides Hurricane Sandy, all the macroeconomy and whether there's some like booming of the city and all the things are the same between this orange and apple. So actually, we are using this orange natural growth to infer this orange natural growth to infer for this treatment group, if hurricane hadn't happened, what would have been for this treatment group? That's a counterfactual. We cannot know. Nobody can know because it already happened. But we believe this treatment and control, in the absence of that treatment, will follow the same trend. So we use this trend to infer the trend of this in the absence of that treatment. So that's the counterfactual thing. This is a counterfactual here. So that's the assumption. We must test that our assumption is true.
But everything else held constant, like market, even then, if the building material is like subpar on this side, and then it corrodes faster, like, so do we still need to control characteristics?
Yeah, we can control as much as possible. So but for the trash can, we assume they are similar.
So if they're controlling for characteristics so much, like what's the difference between diff and diff and matching? How different is it?
Oh, they are using in different scenarios. So for this overtime matching, you don't need overtime thing. If you only observe one cross-sectional thing, you can still do, right? This one, maybe you only have 2 areas, but you don't have so many together, then you use this. They are not like one is much better than the other. It's totally data and all the context.
I would imagine that, so immediately after the hurricane, the growth in the apple would be a lot smaller. But say if you extended the study over a much longer period of time, say 6, 7 years, maybe that difference would start to
diverge.
Yeah, it would not be
yeah.
so much.
Yes,
so
yes.
I'm curious to know what the period of the study studies?
Yes, that's a good point. It's not a definite answer. That depends on the data and the study research question. But it's not like yesterday and today, not that like that. It's not so immediate change because all the housing market is gradually change. So years, like 2 years before, 2 years after, something like that. Yeah.
So the gap between the DID, apple, and orange is the climate risk.
Yeah. Yeah, that's the impact of the climate risk on the outcome. The outcome may be a housing price. That's why. The treatment is the climate. Okay, good. Okay, now let's position. Just now remember this. This is a framework that you don't need to memorize. If you grasp all this, PhD, PhD graduate. So don't worry. I need to first make sure that you don't worry. Yes, but the idea is, as I said last time, we really hope you can grasp OLS that you run regression. And you have some more sophisticated specification. But you really want to do this, you say, okay, now I understand. Causal inference is so important. We just don't want to draw naive conclusion, just a correlation. If you have that goal in your mind, you want to be more advanced, then we already talked matching. Matching, and matching like a geographic matching like that, and more sophisticated called propensity score matching. No need to really get into this unless you want to do a PhD. And now today we are talking about DID. Difference in differences, DID. So that's the thing here. So now we have at least 2. We grasp 1, 2 out of 4. And instrument variable, so sophisticated. RDD, later I will touch a little bit on this. And then you know the golden thing is the experiment. But not so everyone's lucky to run an experiment, right? But if you do an experiment, that's the best. So now you understand the big picture. And then to give you some algebra, it's so easy. So like this, property inside the flat zone, this. Property outside the flat zone, this. So that's over time, right? Now, this is economy is bad, so overall this trend is going down, but many times it's going up. But anyway, let's say the overall trend going down. Then we understand all other trends similar. Suddenly there's a hurricane. Then for the treatment will be a bigger job. So our focus, our goal is to get this treatment effect, which is this big gap back here. Then the apple-orange thing, the algebra is like this. Treated control by T1, T2, C1, C2, then you just have the first difference, then the second difference. So that's the expression of this. And then just now we called parallel trend. Is this. Before, these 2 groups should have the similar trend. That's the assumption. If this assumption doesn't hold, then game over, cannot use. So to do DID, must first test the parallel trend is before anything has happened, these 2 have the similar trend. This is called parallel trend assumption. If they are not have this, it cannot use, but not at the end of word because we have other approaches. You can, DID cannot be used. Then we go to others. That's econometrician. Then they always daily dealing with these things. Okay, now I talk too much about methodology. Let's see some application. So I'm gonna have this, I go back to that paper. That paper you will read. So Sandy, 2012, hit New York. And then they say, okay, this is a perfect setting for DID because not all the communities got hit. Some got, some not. Then treatment and control. And then the research question is, Hurricane Sandy on New York City housing market, what's the impact of that? And then they say, okay, they collect all the data. The New York City is not that difficult to collect the housing transaction. It's very easy. And then they gel code. And then also they got FEMA data on the damage. The good thing is they really have the damage. They have the damage data, the building. They have several damage levels. Okay, they find properties in flood zone had 8% persistent price penalty after Sandy. So remember, 8% persistent. Not like, oh, after 70, the next year, 8%. The second year, people forgot about that and then recover, and then later fully recover. They said, no, persistent. So that's their finding. But I need to let you know, now this area of research, a lot of papers, and they have different findings. They are inconsistent. Some papers they found temporary and then recover. Some they found persistent. So then you cannot say, oh, you are wrong, you are right. No, because they are looking at different hurricanes, they have different data sets. Okay, so algebra. Empirical specification, DID, right? DID here is log P, and this is a variable name, it's very complicated. You just look at this dummy. Treatment, cells in the flood zone times post. So here, maybe I need a little bit like 1 minute explanation of this. Because otherwise, when you look at paper, you got confused. So the point is the following. You have log P. That's very clear, hedonic. Then you have beta 1, this, IX, this all the controls, like number of rooms, like this, school, subway. Then you have another beta times trait. Trait is some dummy of the, let's see, alpha. Beta 1 plus beta 2 times after plus beta 3. This is the interaction. So that's a specification. So what do you mean by this? When we suddenly become so complicated, actually it's very intuitive. Think about this. Remember this matrix? This is the trait area, which is the flood zone. This is the control, right? This is before, this is after, the 4 cells. That's the case thing as we showed here. Okay, now when you look at the equation, say the trait, flood zone, before, then trait is 1, right? Trait is dummy, 1. Then after is 0. And after is 0, this is 1, right? So for this part, we only look at this part. The only coefficient can survive is beta 1. Is that right? Before. Because before, after is 0. After is the dummy, only after is 1. 0, 0, 0, 0, 0. Beta 1. And then trait after, this survive. This, yes. This, yes, right? So that's beta 1 plus beta 2 plus beta 3. Yes? Trait after, 3 coefficients. Control, before, 0, 0, 0, 0. And after, 0, 1, 0, right? Only beta 2. Okay, then you have all the parameters. And then you do, okay, now I understand that this difference in what kind of thing is difference, right? Difference. Yes, difference. Further difference. So the thing is, this is the measurement. So when you run this regression, this thing is negative 8%. Is that clear? Okay. If you got so confused, come to my table and think about my apple to orange thing, this thing. Then look at the coefficient. Write down in your paper, you derive. This is the coefficient.
So what's the thesis of this research? Is it that buyers buyers attribute a lower value to houses that have the potential for flood risk.
Yes.
So my issue with that is that based on what we've been told, this research seems to ignore the effects of the increased insurance premiums that are the result of post-storm damage. So, you have to go in and rebuild the location, and then there's going to be a higher holding cost afterwards. So naturally, there should be some correction there that will ultimately revert to a mean. But as far as buyers' preferences, generally in the United States, buyers own homes for 5 to 8 years. So it's not like, I don't understand why a rational buyer would say there was a 1 in 300 year storm that occurred and hit New York. Yes, there's significant damage, but I project that we're going to get another 1 in 300 year storm. Just statistically, that's not a rational decision to make, right? So I don't think that they can attribute that to the effect of that massive storm. It's more the effect of the tail end of it, which is the insurance industry's response to a large
Yes. Yes. So basically, yes, you are right. So for example, if the market is very, very efficient, the information all very efficient, then even before this happens, they understand this place is riskier than this place if you look at the long run. Then that already capitalized into the place discount. So after additional shock, should no change, right? Because they fully understand, they fully capitalize the future things in now.
Well, there should be a little bit of a change because of the change in insurance.
Temporary, like you need to repair and things like that. But later you will just, will become the same. But always this is not enough information. So those buyers at first, they don't have the big capitalization effect. Then after this shock, they understand more. Then the discount appear more. So that's one explanation. And there's other explanations, but what you said also make true because in another paper, exactly the same data, Sandy and New York City, some of them they found recovered. So, and different neighborhoods are so totally different in terms of whether they have insurance and whether they have the capacity to repair and things like that. Okay, technical thing. Any question? You have a question? Beta one before, yes, before trait. Trait is 1. Trait is always 1 for trait, no matter before or after. After is 0, and this is 0. 1 times 0 is 0. So you only have beta 1 there, right? So 1, 0, 1, 0. Yes, I think this, of course, will take time to. At first, I didn't understand. I need to tell you that when I was a PhD student, I didn't learn this. At that time, they have not. The econometrics field advanced very fast in the last 20 years. When I was a PhD student, no DID, no matching things, no. And then we didn't learn. And later, I saw the papers, oh, we're using this. I got so confused. I didn't understand why this interaction term matters. And then I just do all my maths. And then now I understand. Good. Okay. Then I will skip this because this I already told you that's 8%, persistent. And they also have 3 levels of measures. Light measure, 3 levels of damage. Light damage, medium damage, very heavy damage, you see, it's different. The heavy damage, 15% of the discount. And they show, okay, overall stabilized at 8%. For those first dropped a lot and later recover a little bit and finally stable at 8%. So that's for housing. Remember, housing. I think today I'm not gonna have time for commercial, so but next week we will talk about commercial. Then there's a commercial real estate paper says, oh, commercial real estate, Lake Reef data, they should drop after 2 years, fully recover. That's a commercial real estate paper. But I don't understand why that's fully recover. But anyway, there's so many different papers, but for this one, 8% in New York City after Sandy. And also, you see, there's other papers. This is another paper to look at change in the flood risk premium. And then you see this lending. At first, no price differential between a flood zone and non-flood zone. People may be deniers, I don't know, and they don't have knowledge like that. And unfortunately, this area got hit several times. At first, before, no differential. And then one hit. Oh. After this first Hurricane Fran, got discount. And then, unfortunately, got hit again by the Floyd and the further discount. They learn and learn and learn to the extent that are stable, that they understand for this location, the future probability is what, and they fully capitalize that. But it still depends on belief. Maybe no matter how many times, I just don't believe. You don't believe.
About this model, if in China, like one housing development, the first 5 years, if the house broken, the developer will repair. And after 5 years, if the house broken,
the developer is gone.
No, property
Okay,
management
will
company
repair.
But if the climate risk like flooding, the city government will repair. So the trade and after total zero.
Yes, that's something we need to discuss. Who is responsible to repair? If always government is responsible to repair, then they don't care. They still buy and the builders still build. That's a moral hazard. We call it moral hazard. If the thing, the risk, you don't bear risk when you make a decision, moral hazard. You just build, build, build. Yes. Okay, thank you. And today is about housing. And because Juan eaten my time, I cannot go to this. Next week, commercial and guest speaker. Thank you so much.